Qualified mortgage, QM, what makes a mortgage qualified? Meets strict lending standards plus proves borrower's ability to repay. What risky features are not allowed in QMs? Balloon payments, negative amortization, interest-only periods, loan terms greater than 30 years. What does the ability to repay rule require? Lender must verify income, assets, debts, and determine borrower's capacity to repay. Do government-backed loans qualify? Yes, FHA, VA, USDA loans are considered qualified mortgages. Secondary market players, flashcard style. What do Fannie Mae and Freddie Mac have in common? Both are GSEs that buy conforming loans, issue MBSs, and are regulated by FHFA. What makes Ginnie Mae different? It doesn't buy loans or issue MBSs, it guarantees MBSs with government-backed loans. What's special about Farmer Mac? Focuses on rural/agricultural loans, not traditional mortgages. What role does the Federal Home Loan Bank play? Provides funds to lenders via advances using mortgages as collateral. Secondary mortgage market process. What happens when a consumer applies for a home loan? The local bank issues the loan, but sells it to institutions like Fannie Mae to free up capital. What does Fannie Mae do with the purchase loans? It packages them into mortgage-backed securities, MBSs, and sells to investment banks. Who earns from a consumer's mortgage payment? The bank, Fannie Mae, investment banks, and MBS investors all get a cut. Mortgage-backed securities, MBSs, and interest rates. What are the steps in the MBS process? 1. Banks issue and sell loans. 2. Loans are bundled into MBSs. 3. MBS shares sold to investors. 4. Monthly payments flow through to investors. What happens to MBS investors when interest rates rise? They benefit. Higher rates mean higher returns. What happens when interest rates fall? Investors earn less, as new loans carry lower interest. 3. REMICs and CMOs. What is a REMIC? A real estate mortgage investment conduit, a tax-advantaged vehicle that holds MBSs and avoids double taxation. Why were REMICs created? After the Tax Reform Act of 1986, to provide tax benefits for mortgage investors. What's a CMO, collateralized mortgage obligation? A type of security made up of mortgage loans or MBSs, split into tranches based on risk. What role did CMOs play in the 2007 financial crisis? They were packed with high-risk subprime loans, and when borrowers defaulted, the system collapsed. 4. Government-sponsored enterprises, GSEs. What are GSEs? Privately owned financial institutions created by Congress, e.g., Fannie Mae, Freddie Mac, Farmer Mac, FHLB. What benefits do GSEs receive? Line of credit with the U.S. Treasury. Exemption from registering securities with SEC. No state/local income taxes. What is their mission? To make borrowing easier and more affordable, especially for housing, farming, and education. Are GSEs government entities? No, they're private, but backed by the government. 5. Federal Housing Finance Agency, FHFA. What is the FHFA? A federal regulator overseeing Fannie Mae, Freddie Mac, and FHL banks. Why was FHFA created? In 2008, to manage the aftermath of the housing crisis and take conservatorship of Fannie and Freddie. What powers does FHFA have? Regulates loan limits for conforming loans. Sets oversight rules for secondary market players. Sued financial institutions for MBS misrepresentation. Assumption and subject to. What is an alienation, due on sale, clause? It prevents transfer of property without lender consent, allows lender to accelerate the loan if violated. What happens if a buyer assumes a loan? Buyer takes over the loan with the lender's approval. Both original and new borrower may remain liable unless released or novate. What is a subject to transaction? Buyer takes title and makes payments on seller's existing loan without formally assuming it or notifying the lender. What's the difference between a release of liability and a novation? Release removes original borrower's responsibility. Novation replaces original borrower with the new one on the note. What law restricts alienation clause enforcement in family transfers? The Garn-St. Germain Act, 1982. And #/ 128295, loan modification. What is a loan modification? A permanent change to loan terms to make payments more affordable, e.g., lower rate, extended term. What can a loan modification change? Interest rate, monthly payment, payment schedule, and occasionally principal. What problems might occur with loan modifications? Processing delays, misinformation, unnecessary down payment requests, or lien priority issues. Seller financing options. What is seller financing? When the seller provides credit directly to the buyer, often due to financing challenges. What are the 3 seller financing methods? 1. Full financing via mortgage/deed/contract. 2. Second loan supplementing a primary mortgage. 3. Wraparound loan covering both existing and new balances. What's a carryback loan? A loan the seller provides to the buyer can be primary or secondary. Contract for deed. What is a contract for deed? A seller-financed agreement where legal title stays with the seller until full payment, buyer gets equitable title. What's the key benefit of a contract for deed for sellers? Easier repossession if the buyer defaults, often no foreclosure needed. Why is a contract for deed risky for buyers? Legal title stays with seller, missed payments can cause contract cancellation and loss of all equity. Can a vendee, buyer, sell their interest in the property? Yes, but it may require seller's consent and is subject to contract terms. Buy-down is seller financing alternative. What is a buy-down? A lump sum paid at closing to reduce a loan's interest rate, temporary or permanent. What's a 3-to-1 or 2-to-1 buy-down? Temporary rate reductions over the first few years. 3-to-1, rate increases 1% annually for 3 years. 2-to-1, rate increases 1% annually for 2 years. Why would a seller use a buy-down? To help a buyer qualify or make the property more attractive in a slow market. Junior finance instruments. What is a junior lien? A loan secured by a property already encumbered by a senior lien. What are common junior financing options? Second mortgage, carryback loan, home equity loan/HELOC, third mortgage. Why do junior loans usually have higher interest rates? They are riskier, paid after senior liens in foreclosure. Lien priority. How is lien priority typically determined? By the date of recording, first in time, first in right. What are exceptions to the lien priority rule? 1. Property taxes, always first. 2. Mechanics liens, may start from the work start date. What is a subordination agreement? An agreement where a senior lien gives up priority to a junior lien. What is a lifting clause? Allows refinancing of a senior lien without changing lien positions, used to protect junior lien holders. And #/ 128313, VA Home Loan, General Benefits. What is the main advantage of the VA Home Loan? No down payment is required, as long as the sales price doesn't exceed the appraised value. Do VA loans require private mortgage insurance, PMI? No, VA loans do not require PMI, even with low down payments. Can VA loans help with closing costs? Yes, closing costs are limited by the VA, and some can be paid by the seller. Can VA loans be paid off early without penalty? Yes, borrowers can pay off their VA loan early with no penalty. Can the VA help borrowers avoid foreclosure? Yes, the VA offers counseling and support to help prevent foreclosure. Is the VA loan benefit reusable? Yes, if the previous loan is paid off, entitlement can be restored and reused. And #/ 128313, VA loan eligibility and property use. What determines VA loan eligibility? Length/type of service, credit, income, and a valid certificate of eligibility, COE. Who can use the VA loan benefit? veterans, active duty, reservists, National Guard, some government employees, and qualifying surviving spouses.